If you invested £1,000 in a simple index fund 20 years ago and just left it alone, it would be worth over £5,000 today. But here's the crazy part. Most people with £1,000 sitting in their account right now won't invest a single penny of it. It'll just sit in a current account earning basically nothing while inflation quietly eats it alive. So today, I'm giving you the exact plan I'd follow if I had £1,000 to invest right now, step by step in order. Stick around for the final step because most people do it completely backwards. This isn't about picking the next big stock or timing the market perfectly. It's about a simple, repeatable order of operations that works whether you're starting with £1,000 or £100,000. Here's the rule for the whole video. Protect first, then grow, then optimize. Let's break it down. Step 1. Check for high-interest debt first. Problem: jumping straight into investing while carrying high-interest debt like credit cards or overdrafts. Why it matters: no investment reliably returns more than the interest you're paying on high-interest debt. Investing while in debt is like filling a bucket with a hole in the bottom. Real example: a credit card charging 24% APR is a guaranteed 24% loss every year that debt sits there. The stock market averages roughly 7 to 10% a year over the long term, nowhere close to beating that guaranteed cost. Step-by-step solution. 1. List all debts by interest rate, highest to lowest. 2. If any debt is above roughly 8 to 10% interest, pay that down first with your £1,000. 3. Once high-interest debt is cleared, move to step 2. Common mistake: investing for growth while ignoring debt that's growing faster than any investment could realistically outpace. Common mistake: treating investments as your emergency fund. Markets don't dip on your schedule. Step 3. Use a tax-efficient account. Problem: investing through a regular account and missing out on free tax protection. Why it matters: in the UK, a stocks and shares ISA lets your investments grow completely free of capital gains tax and dividend tax, up to £20,000 a year. That's money you'd otherwise hand to HMRC for no reason. Real example: £1,000 grown to £5 Odu Kalala outside an ISA could trigger capital gains tax on the £4,000 profit. Inside an ISA, that same £4,000 profit is entirely tax-free. Step-by-step solution. 1. Open a stocks and shares ISA with a low-cost provider. 2. Compare platform fees. Look for low percentage fees under about 0.25%. 3. Invest your £1,000 through the ISA. Common mistake: assuming ISAs are only for people with lots of money. There's no minimum that makes it worth it. The tax protection applies from pound 1. Step 4. Start with a low-cost index fund. Problem: trying to pick individual winning stocks with your first £1,000. Why it matters: most professional fund managers fail to beat a simple index fund over the long run. A low-cost global index fund gives you instant diversification across thousands of companies. Real example: a global index tracker fund holds shares in companies across the US, Europe, and Asia. So if one sector struggles, others can offset it. A single stock pick has no such cushion. Step-by-step solution. 1. Choose a globally diversified index fund with a low expense ratio. 2. Put the majority of your £1,000 here. 3. Set up a regular monthly top-up. Common mistake: overcomplicating the first investment. You don't need 15 different funds. One solid, diversified core fund is enough to start. Common mistake: letting excitement about one company override the basic principle of not putting all your eggs in one basket. Step 6. Automate and leave it alone. Problem: checking your portfolio every day and reacting to every small dip. Why it matters: the investors who do best are often the ones who check their accounts the least. Constant checking leads to emotional decisions, panic selling on dips. Real example: studies on investor behavior consistently show that investors who trade frequently underperform those who set up automatic contributions and simply leave their investments alone. Step-by-step solution. 1. Set up automatic monthly contributions. 2. Check your portfolio quarterly at most, not daily. 3. Write down your long-term goal. Common mistake: confusing doing something with doing something useful. Often, the best action is no action at all. Here's the exact order I'd follow with £1,000 today. 1. Clear any high-interest debt first. 2. Set aside a small emergency cushion. 3. Open a stocks and shares ISA. 4. Put the bulk into a low-cost index fund. 5. Automate future contributions. £1,000 isn't about getting rich overnight. It's about building the habit and the structure that turns into real wealth over the next 10, 20, 30 years. If this helped, subscribe for more Real Talk money breakdowns and tell me in the comments, what would you do with your first £1,000?